So in order to save money and resources, we like to reuse the bags we pick our bay trash with. It's a bit of a pain, but worth it. And if you're looking to save a little money on your next life insurance policy, here's a few tips. First is your only option to buy term life insurance isn't the longest term. We see many people default to the 30-year terms offered by many companies, but those are also the most expensive term lengths, and sometimes, let's say in the case you got a nicotine rating or some sort of adverse health rating on your policy, and you plan for in a few years for that condition to improve, it's best to buy a short term like a 10-year term. You'll pay roughly 1/4 of the cost for the same death benefit, which can make up for any added cost for health ratings, and then when you can improve that condition, you can just go ahead and reapply. Next is on a traditional whole life and buying a policy with a paid up option on it. If you look at the contract for many whole life insurance plans, you'll see the contract isn't actually scheduled to end until age 100 or age 121. This means that monthly premium is going to be payable until you hit that unlikely age. So very much like I noted on the mortgage, the longer the maturity date on a whole life insurance policy, the cheaper your monthly premium. But often not discussed are policies that are designed to be paid up within 30, 20, or even 10 years after paying premiums. Of course, these are whole life plans, so after that time period's up, this means they're permanent coverage, you pay no more money. Now, the premiums on those shorter maturity dates are more expensive monthly. But if you look at the lifetime of the payment, just like a loan, it is far cheaper to do these shorter maturity date. So that smaller monthly premium being paid on for that much longer means you paid thousands of dollars extra for the same death benefit. Lastly are for excess cash accruing universal life plans. Some people have these plans but don't actually intend to use the cash accrued. They just saw it as a nice feature in case an emergency were to arise. But they don't like the idea of having to take out a policy loan and pay a loan interest rate or have their death benefit reduced. But if your cash value is high enough, you can actually just let that value pay for your premiums. The universal life insurance plan automatically deducts your cost of insurance from your cash value. And this occurs without you having to take a policy loan. If you're in the right position, you can stop making premium payments and allow the policy to fund itself. This means no loan repayment or reduction in death benefit while not paying any more premiums.